Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, along with the People's Voice, Sydney Freed. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Today, we are welcoming Bob Lang. He is a chief options strategist at explosiveoptions.net. And today, we're going to be talking about options and the markets, why stocks might not be the best place to be this year. And our word of the day is convexity. It's what turns a straight line market into a curveball. And this episode is brought to you by the number 0. That's how many rate cuts Bob here believes we are getting this year. Markets are pricing in 2 to 3. Will there be a reckoning? So Bob, we had some volatility this March. We got some action. What are you seeing? We've seen things kind of calm down here, but traders are looking for a bottom.
Right. And, as we all know, for options traders especially, volatility is our best friend. And frankly,
yours.
My best friend is an options trader. But actually, for stock traders, think about it. It's a great opportunity to catch stocks when they come down way too far. And that's really important for long-term investing, right? You want to, what's the old mantra? Buy low, sell high, right? And you want to be able to...
Unless you're the Fed?
Unless you're the Fed when you're selling high and buying low, right? So I think that these drops or dips in the market are tremendous opportunities for you to step in there and buy some stocks. And the high volatility, how we use the high volatility with options is you can use put options as a way of getting yourself into stocks at lower prices than current levels. And, it's by selling premium. We talk about buying and selling options. So if you're selling puts, for instance, you're able to say to yourself, okay, look, I would like to get into Microsoft at $350, but it's currently $380, right? What do? So I can do one of two things. I can either step in there and start selling some puts, or I can just wait until it gets to that level. Why not be aggressive and be active and not necessarily reckless? Get in there, sell some puts against Microsoft, and at least for the stock that you were willing to buy, you have that cash available, and might as well get paid the premium for Microsoft while you're waiting for that to get to the price that you want to buy the stock at.
Yeah, and we're going to be weaving in those options strategy throughout here. I want to hone in on something you said just a little bit earlier. You were talking about how sometimes markets overshoot, and this directly relates to our word of the day, and that is convexity. So let me just... This can be a little mind-bending, but the payoff is worth it, so stick with me here. Convexity measures how a bond or options price changes as interest rates or other factors shift. It shows how the price curve bends, not just how it moves. And so sometimes markets overshoot, like especially to the downside, so we can have both positive and negative convexity. Positive convexity, so if you take a plain vanilla bond, it gains more when rates fall than when it loses when rates rise. And so that's good. It makes the return smoother. You can also have negative convexity like we see in mortgage-backed securities. These mortgage bonds might lose more when rates rise, but gain less when rates fall. And this happens because borrowers refinance, but we don't have to get into the mortgage market right now. The point is that sometimes markets overshoot in one direction versus the other, and that's kind of what we're looking for. That provides opportunity, and that's what you're looking at here.
That's exactly right, Jared. And what we're looking for when it comes to convexity is the steepness of that curve, right? And we have convexity not just in the bond market, but we also have it in volatility. We have it in equity futures. We have it in the gold futures. But all across whenever there's a term structure meaning that there's price on the y-axis and time on the x-axis, right? And when the curve looks steep going up from bottom left to upper right, that's when you have a positive convexity, which is what you're talking about, which is good for markets. It's when the inverse, or we have something that's called backwardation, that's a negative convexity curve, and that is generally pretty dangerous for markets. But to your point about the convexity argument, what we're looking for is some positiveness there to keep markets rolling to the upside.
Is convexity, though, something for an average investor? Because it still kind of seems a little mind-bending to me. Do you have to consult a financial advisor or someone to help you? ChatGPT, or is there a way that you can easily assess that online or something?
Yeah, Sydney, that's a great point. So I think that most investors average investors really don't need to worry about the convexity part. It's really a very complicated tool that most hedge fund managers or mutual fund managers, it's a much more complex idea that people are modeling their portfolios after. But as the average investor, it's probably very, very useless and not really something that they really need to use.
Yeah. What are you kind of advising for average investors with the kind of volatility we're seeing right now? We talked about how maybe it's a good buying opportunity.
Yeah.
So for the average person, should they put some extra cash in now?
Well, yeah, but then there's also a lot of people who already have money in the markets, and what do, right? You have to buy some protection. I'm always a huge advocate for protecting your portfolios, right? I mean, think of it as insurance, right? So, we all have health insurance. Some of us have life insurance. We drive cars. We have car insurance, fire insurance, everything, right? And why do we buy this insurance? We're not buying these pieces of insurance for a return, because we know that money is just going to be a sunk cost, right? But we buy that insurance to protect ourselves against a disaster happening, right? And we've seen market disasters happen over long periods of time. They're not frequent, clearly, but hopefully, a fire in your house is not frequent either, right? Or an earthquake. But what we're trying to do is we're just trying to protect ourselves and reduce some of the volatility that can come up from uncertainty. Remember something, the markets don't like uncertainty. And uncertain outcomes tend to make people scared, fearful, and worried and nervous, and they force them to hit the sell button on their computers when it's probably the wrong thing to do. When volatility is starting to rise, that's when you got to be starting to get greedy and say to yourself, okay, this is where my opportunities are going to come in. But as it relates to market volatility, most people are scared and worried. We're all on the same spectrum of fear and greed, right? Every single
it's all relative.
All 8 billion people, and that's right, all 8 billion people on the planet. We're all fearful about losing money, greedy about making money. Every single person on the planet feels the same way. So that makes it really easy, only dealing with two emotions here, right? So when we're coming up to volatility here, we're scared and worried about losing our money, but we're also greedy about making money. But the rationale just doesn't seem to square when it comes to rising volatility, that you should say to yourself, oh, well, this is good. I'm going to get in there and start buying stuff. Most people don't do that. They have the wrong action, which is basically selling when they shouldn't be selling.
Well, another thing that people do is the VIX goes up and people say, oh, we're going into a bear market. VIX is at 30. I better buy the VIX. But that is precisely when they might want to be doing the reverse, or at least not touching it.
Exactly.
And I think it kind of comes back to a point. You buy protection when you don't need it, so that you have it when you do. And if you're already caught up in this market sell-off, it's probably a little bit late for that. What do you think about that? Is there something that somebody can do when the market is already turning against them, or is it just too late?
I'm happy to brought that topic up because don't forget, when volatility is low, it means that options are being priced rather low. When volatility is high, or when it's running hot, that means option prices are expensive.
Yeah.
They're going to cost you more money. And why is that? It's because people are reaching for protection. They're reaching for more puts, and it makes it much more expensive when the demand is there, but the supply is not equaling out to the demand. When the demand is really high and when the demand is very strong for puts, we see volatility really take off to the upside. We saw that back in August of last year. Remember when they had
that was Yen-mageddon.
The Yen-mageddon. That's exactly right. Yeah. So
my Mageddon's mixed up.
Then we saw the VIX hit 65.
That was insane off of that tiny event. Are things different now? Is the structure of options is the VIX different?
No, I don't think so. I just think that it's just a preponderance of supply and demand. Is there enough supply out there to meet that demand? And during that day, in early August of 2024, there was a lot of demand. There just wasn't a lot of supply. So if you were holding puts, they were becoming very expensive, and you didn't want to sell them to anybody who wanted to buy some protection. So you just saw the price go through the roof. It was actually the third highest VIX we'd seen in history, highest behind COVID, which was the highest, and the financial crisis.
GFC, sure.
That was kind of the high 80s. COVID got into the 90s, this was the third highest.
But the
ever,
market didn't sell
65%.
off.
No,
and so that leads to my question: like, what was? We don't have to dwell on this, but it just seemed like something was different.
Right.
Let me ask you from a different angle, because I've been asking a lot of guests. Seems that we have market correlations have shifted a bit this year. Do you think we're in a different market regime? Do we need a different playbook to attack the markets?
Well, certainly since the election in November, things have been very worrisome for the average investor. I think again, we talk about uncertainty, right? We've seen volatility on the rise on days when we hear about tariffs or the potential for tariffs, and we hear about backlash from other countries and what they're going to do to the United States if we don't remove tariffs or whatever. So we really don't know what the outcome is going to be here. And that's really where the definition of volatility comes in, is do you know what the outcome is going to be? And if you really don't know what it's going to be, then we have that premium, we have that pricing and volatility. So I don't think anything has really changed fundamentally or structurally with volatility. However, I do think that the mentality of people has definitely shifted from a rather slow, easygoing type of environment that we were in, say, for the last 3 or 4 years, to people sitting on the edge of their seat, nervous and worried about what's going to be next.
So maybe they have to work harder now a little bit.
I think they have to think harder. They have to work harder. They have to be reactive and move your feet. I always talk people about the trading. For me, we're in the moving business, not the storage business.
Oh, interesting.
And what that means is I'm moving my feet all the time. I have to move my money around to different areas that are going to be safer and help me get a better return if one or two areas aren't going to do it for me.
On that note, hold that thought. We're going to take a short break. But coming up, we're going to be talking Fed rate cuts. Will there even be any this year? And a runway battle that looks at stag and looks at inflation. Do we end up with bull? This episode is brought to you by the number 0. That's how many rate cuts Bob is expecting this year. Meanwhile, bond market investors have been pricing in 2 to 3 cuts. And only recently, we had a Fed meeting where the latest predictions, the statement of economic predictions, the Fed is expecting about 2 cuts as well. So there's a difference there. What happens? We've seen markets get and investors get the Fed wrong all the time. Sometimes it doesn't matter. Doesn't matter this time if we don't get any rate cuts this year.
It will matter, and the Fed funds futures market is telling us that they're looking for upwards about 3.5 rate cuts this year. It was about 4 about a couple weeks ago. It's down 3.5, maybe slightly less than 3.5. The Fed told us last week that we would be looking at possibly getting 2 rate cuts, down to like 3.9 or 3.8% on the Fed funds. We're currently 4.25 to 4.5. I don't think that we're gonna get there. And as you mentioned, I think we're gonna have 0 rate cuts. Just this morning, I heard Neil Kashkari saying that he doesn't think the next rate cut could be until 2026 or 2027 at the latest. So we're talking well more than a year off till the next rate cut. So I think the Fed is correct when they say that they're paying attention to the data. They're paying attention to what the numbers are telling them to do each and every month. But look, as Chair Powell said a few weeks ago, not last week from the Fed meeting, but actually a few weeks ago, what he said, look, we're going to need to see several data points in order for us to be convinced that inflation is coming down towards our target of 2%. Was he pleased with the recent CPI and PPI data? Sure he was. Why wouldn't he be? However, you got to see several of these numbers. And frankly, leading up to the February data, which came out a couple weeks ago, the inflation had become rather sticky. It certainly had been for the last 6 to 8 months. And that's a problem for the Fed. Remember, what is the Fed's 2 mandates? Stable prices and employment and maximum unemployment, right? They clearly got the second one correct, right? They nailed the second one. But the first one, stable prices, is a huge problem. And what really bothered me last week when he started talking about transitory again, it brought back all sorts of memories.
Oh my goodness.
Oh my goodness.
That was a surprise.
Yeah. He started talking about transitory again. Somebody brought it up and he got real irritated. He's saying, well, are you talking about the last time we were dealing with tariffs?
I remember that exchange very well.
Or we're talking about, after COVID, and I think they were talking about COVID. He got really irritated for that one.
Let me ask you though, what's the make or break? Is it PCE? Is that the main report we should be watching? Is it other data? Is it the softer data?
So hard versus soft is kind of a bigger question here. We've been seeing that big dichotomy.
I would say that the Fed pays about 4 times more attention to the hard data than the soft data. They acknowledge the soft data is important, but they really pay more attention to what the hard data is. So you answer your question, I think that personal consumption expenditure, the spending and income data, very, very important. We got jobs data coming out next week as well too. Chair Powell has stated that wages and wage growth hasn't really been inflationary. We take him at his word, he's right. But I think the inflation numbers that are going to be coming out this week on the 28th of March are very important. And we'll see a trend starting to develop off those numbers.
What happens to the stock market if we don't get a rate cut? Because that makes me nervous.
Yeah. Well, I don't. You guys remember last year, the Fed funds futures market was projecting 7 rate cuts
at the beginning of the year.
Beginning of 2024.
And that was my point, that it didn't seem to matter that much. We had 20% plus returns in the stock market.
Sure.
So at what point does the market say, okay, our expectations, there's going to be a reckoning? Do we hit that point this year? I think that's what we're asking.
Well, looking back last year in 2024, we had a huge reckoning in April of last year. Markets got hammered when the Fed funds futures market made an adjustment from about 6 rate cut expectations down to 3. We ended up getting 4 last year in 2024, but still, I think coming back down by the futures market is going to be an important component. And to answer your question, Sydney, yes, I think the market is going to be shocked when they come to Jesus moment and they realize that, you know what, the Fed is not going to be moving off of 4.25. I want to say back in the December meeting, or the October meeting just before then, Chair Powell said this, and this stuck with me. He said, we really don't know where the neutral rate is.
Yes.
This is after they've already cut 2 or 3 times. So that stuck with me because thinking, well, it could be right here. It could be higher. It could be lower from where we're at right now.
Feeling around in the dark.
It's a shooting target, right? They're shooting at a target they really don't know where it's at. So like they're blindfolded or something like that. So I think that's an important component as well too. So they're still trying to find that neutral rate. They're still trying to find out where the market is at for Fed funds.
Do you think how does transparency at the Fed and communication kind of work into your analysis? Because, and this is kind of a big picture question, we've seen markets react a lot of times more towards what the Fed is thinking than what the actual data is saying. Do you think that skewing is still in effect here, or is that any kind of problem that you see?
No, I think that's still pretty much in effect too. And I think, when you listen to some of the other Fed speakers out there, just yesterday, Adriana Kugler, has generally been more neutral. She came out with some really hawkish tone yesterday. And I think that's important to pay attention to. The Fed really wants to err on the side of caution as opposed to being aggressive and giving the market what it wants. And I think right now, as you talked about how, the market is going to be disappointed if they don't get the rate cuts. Well, that's life. Life is full of disappointments, and market is going to be having to deal with the fact that the Fed is going to be much more cautious here and not going to overstep their bounds and create more inflation. Listen, last week's Fed meeting, I think Chair Powell was extremely clear when he said that tariffs are going to cause some inflation, even if it's short-term inflation. And the problem with short-term inflation, it tends to stick around for a lot longer than you realize. So that's certainly going to be a problem.
That is a perfect segue into our runway battle here, because we got 2 heavyweight forces that are strutting down the runway. First up, it's sticky sticker shock. Inflation that just won't quit. Prices are high, wages are rising, and the Fed is keeping its arms crossed. Then there is the growth slump, slow, sullen, and dragging its feet. Corporate earnings and wobbling, and economic momentum is MIA. But don't look away. There's a third model lurking behind the curtain, and that is the dreaded hybrid, stagflation. When prices prices stay hot and growth goes cold, and the result is an outfit no one wants to wear. Not consumers, not investors, not central bankers. So Bob, which one is really commanding the catwalk in 2025? Is it inflation? Is it slowing growth? Or the portmanteau of the two, stagflation?
Yeah, I think that stagflation has been talked about quite a bit, but as we've approached that potential of stagflation, we've never really crossed that line to get there. And we really haven't had stagflation since like the 70s.
Yeah, nobody remembers it mostly who've been in the market, even for a long time.
That's right. And so I think the Fed is much more concerned right now about inflation. Growth is not really that big of a problem. I know there's a lot of people who like to quote the Atlanta Fed GDP now, came in at like a minus 2.3%.
Changes a lot, yeah.
But you know what, by the same token, and in all fairness, there are two other Federal Reserve banks, St. Louis and New York Fed, that say that this first quarter is growing at about 2.3 to 2.4% positive. So, you know, who do you believe, right? Yeah, the inputs, the data inputs are maybe they're different. Regardless,
and sometimes GDP is revised with an opposite sign after the fact anyways.
That's right. And tomorrow we're going to get another revision from Q4 GDP. That's on March 27th in the morning. So I think that the Fed is much more concerned with inflation, and as they should be. I don't think growth is really that much of a factor yet. It could certainly get to that point, but certainly the data that we've seen is not showing that the economy is slowing down very, very quickly at all. Again, you know, the effect of tariffs is having a huge negative effect on sentiment, consumer sentiment especially, and how much longer that's going to keep an effect against the consumer is anyone's guess. But certainly the longer it lingers, the worse it's going to get.
Bob, we have just about a minute here. Yes. So you worked for a pension fund back in the day. You ran a hedge fund. You dabbled in options. Now you have your own company. Give us like your best financial lesson for working in the careers that you have.
Well, I think that one of the lessons that I learned from years ago is always have some protection on and always keep some cash available for opportunities. You know, there's always going to be an opportunity, and you know, your opportunities are made from someone's unfortunate or misfortune, let's say. You know, I believe in luck. Sometimes, you know, luck is where preparation meets opportunity, right? So I have to say that sometimes you have to feel lucky to get opportunities that are presented in front of you. So I think as far as investing is concerned, we just want to be able to go slower roll sometimes, but be a little bit more aggressive on the investing side and take our cues from what the market is telling us.
Wise words, and I believe we can create our own luck here, especially at Stocks in Translation, so make sure you tune in next time.